Let me buy it. Your poor excuse for a salesman. It's not intraday anymore? What is it? Oh, it's because the market's closed. Smart. QQQ is still dumping. Perfect. Alright, damn. That's fucking brutal. I lost another 70 points in after hours. Well, as you can see, we exceeded the market maker's expected move by, just a couple hundred basis points. This brings us down to the like near the bottom of my expected bearish range. There should be some support around 58.50 or so. We might see bulls build more support around that level going into tomorrow. For ES, we've broken through the bear signal to the downside at 59.48. Now there's a couple supports in here. The next one to the downside at 58.93. The one here at spot 59.23. So possibly find a little bit of support here below the bear signal. Maybe retest it tomorrow. And that would give us a better confirmation of a continuation. Retest and fail. So I'd be on the lookout for that. Dollar obviously just absolutely fucking ripped today, up 100 points. Top end of the yield curve moving up very strongly as well, with the 10-year ending the day at 4.51, the first level of significant risk for banks with hold-to-maturities that are underwater. The 20-year at 4.763, and the 30-year at 4.657. Commodities pretty flat, actually, surprisingly. Oil was up above 70 a little bit earlier today, fell back below. Gold slipping with the rise in the dollar, as is silver and copper. The rest of the precious metals not doing too well either. Agriculture, materials, not too much of a change. Correlation broke out. We got that correlated move between core 1 month and 3 month today, and we see correlation on the 1 month surge ahead of the 3 month, which is kind of what we talked about last night. And as those become more highly correlated and they continue moving up, we can expect to see dispersion between indexes and their underlyings break down, which means higher vol downside on SPX, NQ, etc. Now, interestingly, despite all of this negative price action, leverage in the carry trade has risen, and it is rising pretty rapidly into the Bank of Japan decision tonight, where they are expected. Now, this is weird. It seems that the consensus by the people leveraging up the carry is that the Bank of Japan will not do anything, right? But as far as the swap market's concerned, there's still about an 87% chance that the bank raises tonight. And if they do raise rates tonight, everybody who's massively over leveraged in this carry right now is going to be put in a very similar situation to the one they were put in August, when leverage was actually lower going into the bank's decision. So if Bank of Japan were to surprise raise rates tonight, and I wouldn't really say it's a surprise given that it's being priced in by the swap market, but it would be a surprise to everybody who's over levered in this trade. That could really shit up. I mean, you're talking about a rapid collapse in the currency spread and a probably very significant drop in the dollar immediately after it breaks out. Right, and so that would upset all of the pricing that has been readjusted with today's FOMC announcement. Not to mention, absolutely destroy marginable securities. So really, really, really important decision. 10 p.m. Eastern time. Also, something else to note, and this is very rare. The forward yield on volatility has closed at positive 37.27%. Usually, that does not close positive. And not only did it close positive, but it closed well above the forward yield for bonds, which means that the desire to hedge the forward yield on volatility from bond portfolio holders is going to be very, very high. Jesus Christ, Vega puts, I love you. Core 1 month or 3 month rising really, really rapidly. We don't have a print from Move yet, but I'm going to tell you that Move is also going to move back up very significantly today, probably back over 100. Rename Meatball to Lightning Picks. Okay, sure. How about we call them Thor's Little Hammer? TLH. Thunder Prawns. That's even better. Skew neared its all-time high again yesterday, showing that, bulls were wildly unprepared for today's price action, and there was very little tail risk hedging on the index. Not a lot of bot puts, basically. All the puts on the index were sold, and we pretty much plummeted straight through the majority of them. That's really important going into OPEX this Friday, because a lot of our support and what was keeping prices propped up, despite the fact that 20% of the S&P, now even more of the S&P is going to be under its 20-day moving average after today. This will update in about 5 minutes. But the last vestiges holding the market up were massive charm flows from in the money call positions that had been squeezed out, and also tech. Now both of those are now, well, the market sold off. Those in the money calls are no longer providing supportive charm, quite the opposite, actually. And now tech has also been selling off. Safe to say we got rejected off the 1929 trend line. I mean, yeah, we were within a few dollars of it. I don't like it that it missed, but I feel like the line I drew was pretty accurate. But yeah, I mean, we tested it and failed it, so one could say that. And we did finally get our big spike on vol, which came alongside a little bit of drop in correlation between VIX and cash VIX. However, that build up proved out, right? That improved correlation that we'd been watching over the last couple of weeks did finally see some realization today, with a much bigger move in volatility. So always something really good to pay attention to, those correlation metrics there. And Fed funds futures rapidly pricing out the rest of the rate cuts for 2025. Earlier going into today, it was sitting at about one rate cut by June of 2025. That's now down to 1.7. If we see inflation expectations increase now, that will be bearish. It will no longer be bullish. Okay, so we've had about a year and a half where rising inflation expectations meant expanding margins, and now Fed fund futures have kind of flipped the other way, and rising inflation expectations will mean tighter financial conditions and higher for longer rates. Okay, so we're kind of back to that late 2022 environment, not the mid 2023, early 2024 environment. And that's going to be something that's really important when assessing the macro data as it continues to come in. And then lastly, the 10 2-year spread at looks like positive 15.5%. Hasn't really gotten super crazy yet, but if we go back like a very long time ago, we can see, there were some periods right around the COVID crash, around 2008, around the dot-com bubble, where we did see the 10 2-year spread turn even more positive than it currently is. We're not there yet. I would say that we probably need to break out about 23.5% before that starts to become really detrimental to credit markets. We're gonna RRP on train more rapidly. They cut the on RRP by 30 points. Did you see that? I think we're gonna start to see. We're gonna start to see the last vestiges of liquidity drain now. So not just RRP, right? But so we got about 3.21 trillion. This has been draining pretty steadily from 3.6 trillion in March. I think we're going to start to see that come down pretty rapidly, like we did in 2022, where the reserves got hit. VIX tapped 28. This seems to be the nail in the coffin that has existed since. Well, yeah. I mean, this is the Fed giving up their hold on protecting the banks. Fidelity, thanks for selling my bajillion XD0 GT puts before it bajillion X'd. Oh no. My bank's been really pushing me to open a savings account. Banker was downright harassing me and I wasn't interested. I don't know, that could just be like commission based. I'm sure there's an incentive for the commission, but Gork, I didn't trade today. It's okay, there's always tomorrow. Alright, well, that's about it. We'll see where this carries out into the end of the week. Thank you guys so much for tuning in. I hope everyone did pretty well today. I think it was a pretty easy trade to the downside. So, catch y'all later. Have a great night, guys.